Back in 1982, Silicon Valley Bank became the lifeline of startup in the tech hub, providing them with the much needed funding to grow and prosper until this happened.
SVB, the 16th largest bank in the US with $175 billion in deposits, is now the biggest American bank to fail since the 2008 financial crisis.
However, what's interesting is that this bank's downfall wasn't due to the bursting of the real estate bubble or a failed investment in a cryptocurrency project. Instead, it collapsed because of its investment in one of the safest instruments in the world: government treasury bonds. Join us as we explore the inside story of the financial disaster that shook the tech world, the collapse of the Silicon Valley Bank. In the early 80s, the startup ecosystem was very different from what we see today. Startups struggled to find even a basic services to help them grow in the business world. But the biggest challenge they faced was getting a bank to invest in their vision. Traditional banks were not interested in taking a risk on young, unproven companies. Enter the Silicon Valley Bank. This innovative bank recognized the need for the startups to have the access to the banking services and took a chance on them. They became the go-to bank for the startups seeking fund and support, offering specialized services tailored to their unique needs of the startup world. This is the bank that is heavily concentrated in the Silicon Valley, working with the smaller tech companies that have a big ambitions but less secure fundamentals. These companies need banking services too, and that's where the Silicon Valley Bank comes in. They offer everything from checking and saving accounts to credit revolvers and the lending facilities. But here's the thing, Silicon Valley Bank is much more concentrated in one industry than other banks like a JP Morgan or a Bank of America, which increases their risks. This is particularly relevant with the significant tech layoffs and intense competition in the industry. However, the tech is not the only factor contributing to the bank's risky business model. There's another catalyst that has played a crucial role. Imagine you are one of the millions of the people who lost their jobs due to the pandemic in 2019. But luckily, the government gave you the stimulus check to help you throughout the tough times. You didn't spend all of it. You decided to deposit some of that money into your bank account. Now this is where the things get interesting. Banks make money by taking on us deposits and investing that money into the other ventures. As more and more people deposited their stimulus checks, banks like Silicon Valley saw a huge influx of deposits. This meant that they had more money to invest and they were making more money in return. In fact, Silicon Valley Bank revenue doubled from 2019 to 2020 in just over a year. But with all this money coming in an astronomical pace, this bank faced a problem. They had to decide what to do with all the cash. They had a huge pile of money and they needed to put it to work to make even more money. That's how the bank operates. But with such an unhealthy pace of deposit growth, the bank was at risk of running into trouble. And that's exactly what happened. Silicon Valley struggled to invest all the deposits they had taken on and ended up making more risky investments, leading to their financial downfall. And that investment was government treasury bonds. Take a look at the market yield on a US Treasury securities at a 2-year constant maturity chart. So when banks like Silicon Valley Bank receive a lot of deposits, they have a choice. They can either invest in a short-term assets like 1, 2, 3 months treasuries, but that won't bring in a lot of money. Or they can invest in long-term assets like 10-year treasuries which have a higher interest rates but are also riskier. SVB's 21 billion bond portfolio was yielding an average of 1.79%. The current 10-year treasury yield is about 4.9%. Silicon Valley Bank chooses to invest in the longer duration assets, locking them into the interest rates for the longer period of time. This seemed like a good idea at the time, but it also meant they were taking on more risk. If interest rates started to rise, they would be stuck with long-term assets that weren't bringing in as much money as they could have been. And looking at the situation now, the risk has caught up with them. It all comes to the interest rates. So when Jerome Powell took over the chair of the Federal Reserve, he was worried about the inflation. So he started raising the interest rates all the way up to the 4 or 5%. Now when interest rates go up, it affects the value of the existing loans. That's because investors can now get better return on their money by buying the loans with the higher interest rates. So all those loans that the Silicon Valley Bank locked into the lower rates are now worth less money. It's kind of like when you buy a car and the prices goes down right after you drive it off the lot. The bank was in a similar situation. Their entire bond portfolio was suddenly worth less than they had paid for it. They were in the red, which means they had the unrealized losses. As if things couldn't get any worse for Silicon Valley Bank, another challenge came knocking at their door. Venture capital, the lifeblood of many startups, begins to dry up. As a result, these companies started withdrawing down the funds held by SVB, which created a huge problem. With the bank already struggling due to the unrealized losses in the bonds, and the sudden surge in customer withdrawals only made the matters worse. It was like the perfect storm for the financial troubles for the Silicon Valley Bank. It all started when Silicon Valley Bank made a big announcement that it had sold a bunch of securities at the loss and would be selling $2.25 billion in a new shares to stabilize its balance sheet. This news made venture capital firms nervous, and they advised companies to withdraw their money from the bank. As a result, the bank's stock began to plummet, dragging other banks' shares down with it. People started to fear that this could be a repeat of 2007 and 8 financial crisis. Then on Thursday, $42 billion in one day. SVB bank run was one of the biggest bank run in more than a decade. SVB customers said CEO Greg Becker didn't instill confidence when it urged them to stay calm during a call that began Thursday afternoon. It's a situation straight out of the nightmare for the Silicon Valley Bank. Customers withdrew a jaw-dropping $42 billion of deposits in a single day. According to the California regulatory filings, to make the matter worse, the bank found itself to be a deep hole with a negative cash balance of $958 million by the close of the business on the same day. And to top it all off, it failed to get enough collateral from the other sources, as the regulatory reported. For Timothy, a former employee of SVB, who now runs his own fund, this was a classic example of the interconnectedness of the investment community. He believes that the bank's sudden collapse was due to the heavy reliance on the tech industry, as well as the intense competition and layoffs that characterized the sector. The bank simply couldn't keep up with the rapidly changing landscape, and when the push came to the shove, it was unable to weather the storm. In conclusion, the sudden demise of the Silicon Valley Bank was a classic example of a bank run, where the financial institution couldn't meet the liquidation needs. The situation was aggravated by the interconnected nature of the tech investing community. However, HSBC came to the rescue, buying the SVB UK unit for £1 on March 13, 2023. Thanks for watching our latest business short documentary. We hope you found it informative and engaging. If you enjoyed the video, please give it a thumbs up and consider subscribing to our YouTube channel for more insightful content on the businesses. Also, feel free to leave a comment down below what you think about our videos. Thanks again for your support, and we will see you in the next one.